Welcome to Bank on It, Conversations with First Seacoast Bank. Today's topic, understanding the value in your home investment. I'm your host, Chris Hislop, and here with me today is Gene Tremblay, Senior Vice President and Senior Retail Loan Officer at First Seacoast Bank. Welcome, Gene.
Thank you.
How are you?
I'm good. I'm glad to be here.
Happy to have you. How long have you been with First Seacoast Bank?
I've been with First Seacoast Bank for 12 years now, 40 years in the business, so I'm getting a little up there.
That's a good run.
Yeah.
What are your day-to-day responsibilities with the bank?
My responsibilities run from managing the retail branches as well as running the loan operations, so mortgage and consumer originations. And it takes a good part of my day every single day.
And what got you into this line of work? What do you appreciate about helping people out with their loan and consumer product needs?
Yeah, I think, when you're talking about investments, this is probably the largest investment an individual is going to make for their family, for themselves. And it can be a little daunting for folks to go through this process because it is a process. My whole focus on this has always been I feel really good when I know that I help someone get into a home for the first time, for instance. My focus, particularly in the back room, is to try to create technologies and work with technologies that make it as simple as possible to get into a home or get into a mortgage. And that's really the focus for me is to make it as efficient and helpful as possible for the individual who's looking to get into a home.
Where do you think you have a leg up, when you start to look at, First Seacoast Bank being, a community bank versus, a larger bank or someone that might be applying for a mortgage online through something like Rocket Mortgage, et cetera? Like, how does First Seacoast Bank really position the potential home buyer up for success and just having the ability to stop in and talk to you?
Well, I think we have, as far as technology is concerned, I think we have as good as technology as the big banks in our area. But I think that the main focus for us and the main difference for us is that we have local decision making. So the individuals that actually make the decisions live in the communities. They understand the communities that they live in. And it's part of the community. So when, for instance, an individual comes in for a mortgage application, we have the ability to make that determination within the first couple of days of the analysis. It's quick and we're all right in the same room pretty much when it comes down to it in terms of being able to determine whether we can do a loan or not for an individual.
Nice. What are current challenges that you're faced with in assessing, what might be the right product for a person?
Well, we look at all kinds of things. We look at an individual's income. We look at what their employment situation is. We obviously look at credit. We also look at what ultimately will be the collateral, which is typically in residential lending, is a real estate that's involved. And I think one of the difficult parts today is the market is so tight at this point, not a whole lot of real estate on the market for sale. And when a property does go up for sale, if it's in good shape, you'll have upwards of a dozen people making an offer on that piece of property. To be able to have the ability to make that offer and make the best possible offer to try to get that deal, that's the tough part today with those things. So we do have a pre-qual program, so we can actually provide a letter to the realtor that says if this individual does get to this property, they're should be able to make this loan. Based on what we've seen, we would be comfortable doing this loan, assuming nothing changes during that process.
Mm-hmm. And it's got to be trickier too. I mean, you just mentioned how home prices have definitely inflated in the last 5-6 years, but also to stay competitive with providing an offer. Obviously, that opening bid, if you will, is going to be a little bit higher than maybe even the list price. And there are other variables at play too, like bypassing inspections, et cetera, right?
You're exactly right. When you're looking at listing at this point, the realtors will put a price out on a piece of property and say, let's say it's $500,000, for instance, and it's a nice piece of property. More often than not, the bids that will come in will be quite a bit higher than the actual listing price at this point. And because you're competing with so many people to try to buy this piece of property, you might decide to take the risk of saying, well, you know what, I'm not going to get a home inspection on this thing. I'm not going to get a water test. I'm not going to get a pest inspection. I'm just going to take it as is, and whatever happens, happens. And that's a real tricky and can be a dangerous situation for you, because you're going into a property not knowing what's happening with anything. So your heating system could be on the fritz when you move in there, and it'll be many thousands of dollars to have to replace that. So it's not a good idea to miss on those inspections. But unfortunately, the market the way it is these days, that people are just foregoing that and saying, I'll just take it, and if I have to fix something, I'll do it, and hopefully I'll have the money to do it after the fact. And then because there's so much competition, it's just the prices, the offers are coming in higher than what the homes are being listed at. So it's a difficult market to purchase a piece of property these days.
Do you ever have to have challenging conversations with potential customers because they're anxious to get into a home, and the forefront of their mind is, I am going to bid over the asking price because I want this so badly? But something you had just talked about, like if there are systems within the home that are about to fail, like do they even have the money to afford that? Like how do you start to assess the viability of a loan given the circumstance of bypassing these things?
We get an appraisal, obviously, on the piece of property, and usually the appraiser will, although they're not a home inspector, when they're looking at the property to determine what the value is of that property, because of their experience, they'll have a feel for, this roof looks like it needs, it's been out there for a while, it looks like it might need some replacement, or the furnace is so old that it looks like might need some replacement. So they might put some comments in the appraisal for that. And if that comes in that way, then we have a conversation with the borrower to say, listen, they didn't do an inspection on this, and they're not the inspector, but they're recommending that you get that checked before you purchase a home. So we do have those conversations with them. And sometimes it doesn't show up in an appraisal. So after the fact, when the home is purchased, our borrower might come back to us and say, the appraisal, no, not the appraisal, but the furnace is on the fritz, and I need to do something about that. We have the ability to provide additional financing opportunities for them to do those improvements if they need to. So we have the ability to work with them for things like that.
Nice. Gene, what's the decision-making process like at First Seacoast Bank? How does it unfold? How might it differ from other financial institutions?
I think I mentioned before that our decision process is local. We all work in the same building, but typically our underwriters have an ability to approve a loan up to a certain dollar amount. And if it goes over that dollar amount, then it goes to the next level, which is myself and my senior individual, Stephanie, who works with me as well. So we have the ability to approve loans right then and there up to a significant dollar amount. And even in that instance, if it's over that dollar amount, when we're talking pretty significant jumbo loans, for instance, it goes to a committee level, but every member of the committee is in the same building. So we just chat each other up and make a decision. So it's really quick in terms of that. We put the loan together as far as an underwriting process is together determined, and then we make a decision on the spot.
What's jumbo loan mean?
A jumbo loan, typically, there's something called the secondary market. These are companies that actually purchase loans from banks and mortgage companies as an investment tool. And typically what happens in those cases is we will sell a loan to what we call Freddie Mac, for instance, is one of those companies. So we'll sell the loan to them and we'll keep the servicing rights. So the customer never really has a change because they're still making their payments to the bank, but the bank doesn't own that loan. And these secondary investors have limits in terms of what they'll purchase. And for instance, Freddie's limit could be $750,000. So any dollar amount, $750 or less, is a normal loan. Anything over $750 is considered a jumbo loan. So it's a significant dollar amount loan type of thing. Yeah. And we're in that market where we do see a lot of that because Portsmouth is a pretty, I don't want to say rich, but it's a pretty rich neighborhood. A little bit on the expensive side when you're looking at some waterfront property and that sort of thing. So some of those homes go in pretty significant price levels. And then the folks that are looking to purchase those tend to need some loans and they end up over that dollar amount that secondary investor is looking for. So gotcha. That's a jumbo.
Appreciate it. We're taking a quick pause to bring you what's in your wallet. All right, Gene, we're jumping into a segment we are calling What's in Your Wallet, in parentheses, or app. What is something that you have on you or are currently using that might be of interest to the listener?
Well, I happen to have my father's green thumb, so I do a fair amount of gardening, and I tend to experiment from year to year in terms of what I want to grow, how I want to grow it, and all that kind of stuff. And speaking of grow it, I have an app on my iPad that's called Grow It, and it actually helps me manage the garden that I put together year after year. It's pretty cool. I love it.
What are you growing? Oh,
I'm growing tomatoes, turnips, carrots, cucumbers, peppers, onions, all kinds of stuff. It's a blast.
I think turnips are a really underrated vegetable.
They are.
I love
they are. Yeah.
I think that's my favorite part of Thanksgiving dinner, actually.
Yeah, I had an uncle in Canada who actually had a turnip farm. Huh. And in the fall, we would actually go up and pull them all out of the ground. Yeah. It was a blast.
I love that. It's great. Before we started rolling tape, you had given your definition of what a mortgage is. So I'd love to ask you what your definition of a mortgage is. It's not really, like the way you described it, it's not really a one-size-fits-all type of thing, which is on the surface how somebody might consider it.
Right. Most people think that a mortgage is a mortgage is a mortgage. And, I'm going to get a loan for the home that I'm getting, and I'm going to make specific payments, and it's going to be a specific interest rate, and it's going to, be a specific monthly payment for a term. And there is some standardization as far as loans are concerned, but every individual, every couple, every borrower comes in with their own personal circumstances as far as what they're looking for and what they can bring to the table in terms of the transaction that they're looking to do at this point. So we have to look at all kinds of things, and even though there is some standardization in the lending process, every individual's circumstances comes to the table a little bit differently. So we have to think about each individual loan request and how it stands on its own. So if a customer for instance, has some dings on their credit where they might have been late for some reason, and they do have a legitimate reason why they were beyond the 30 days past due, for instance, we may need to structure the loan a little bit so that maybe they come in with a little bit more of a down payment, so that we create a better partnership in terms of the risk that we're taking as far as the bank is concerned and the individual. Or maybe they have lots of reserves, and reserves are typically the cash that you have on hand, liquidity, your retirement savings, your investments, that kind of thing. Maybe they have a lot of reserves, but their income doesn't show quite the ability to make that payment in a normal sense, because when we're looking at income to debt service, there's certain ratios that we talk about where we figure that a certain amount of income needs to be available to your everyday expenses,
Right.
groceries, utilities, that sort of thing. So you need to have that as part of your transaction. In some instances, your income might not be enough, let's say, as far as the transaction is set up to be able to take care of the payment that you're looking at for the loan you're looking for. But if you have a lot of reserves, or your job that you have looks like it'll be one where it has growth potential and that sort of thing, we might go over our normal numbers because we're looking at the entire picture and saying, okay, well, this is a little not the greatest, but because you've got this situation here, we're willing to take a bigger risk as far as that's concerned. So it's really taking a look at the entire picture for that circumstance and saying, yes, we can do this, and maybe not right today, but if you do this, and this, and we talk again in 6 months, you're probably going to be in a good space, or a year, or what have you. And we work with the individual if we can't do that particular transaction on that day. We work with the individual to help them get to a spot where they can get a loan.
Yeah, and I know we talked about this earlier, but I think that's where perhaps a lot of the value lies in working with a community bank like First Seacoast Bank. Is you're working with them as a partner, not necessarily as a transaction. So yeah, I think that's a pretty invaluable point to keep getting across.
Yeah, I think, when you're talking about the big lenders out there, it is literally a transaction. So if it fits into the bucket that we've got for you, we'll do it. If it doesn't fit, then we're sorry, but we're not interested. Whereas a community bank like us will actually sit and work with the individual borrowers that are there to figure out, okay, what's the best thing that we can do for you in the circumstance that you're in. And sometimes the best thing is, well, maybe not today, but this is what we'll work with you with to get you to a spot where you will be able to do this. Yeah.
And for those customers that are already in homes but are thinking they'd like to get out of that home and purchase the next biggest, greatest thing, what have you, given a lot of the variables that we've talked about here with, the increase in home values, with the competitiveness of the offers that come through when a house is placed on the market, how do you work with somebody that's interested in buying a new home in positioning something different, like an equity loan, like, hey, this isn't looking great right now, but have you considered making the home that you're in currently more comfortable, or more in your mind that dream home you're thinking about, by taking out a different type of loan? Are those conversations that you use as sort of like a tool to get somebody on the right but slightly different path?
Yeah, the market, it's definitely a seller's market at this point. So if you're looking to sell your home, you should be able to sell that home in a very short period of time these days, because the market is so tight. There aren't that many homes for sale at this point. So that if you've got a home that is in good shape and is in a good location and you're very comfortable in that home, if you were to put it on the market today, you'd be able to sell it fairly quickly. And fairly quickly is within several months at the latest, typically. However, because the market is so tight, if you sell your home, it's very difficult to get into another home. Like I said, we're talking about, if you're looking at something that you want to buy that's going to be in really good shape, don't want to kind of move in shape where you don't really want to have to do too much work or that kind of thing, you're going to be competing with a lot of people to do that. And because the market is so tight, it's difficult to purchase a home. I've seen more than a few people who've been looking to buy a home for over a year now. They've been at it 18 months, and they still haven't found anything. So if you're thinking about selling, but it's like if if you're thinking about selling, but you want to stay in the area, sometimes because of the way the market has been over the last several years and the fact that it's a seller's market, the equity in your home has significantly increased over the last several years. So if you refinanced your mortgage 4 or 5 years ago, or right around time just after COVID, I know that's a nasty word, but just after COVID, if you've refinanced around that time and you have a really low interest rate, obviously you don't want to play with that mortgage. We have products that go in behind that mortgage, so that if rather than selling your home, you stay in there and you say, geez, maybe I just stay here, but I'll put an addition on the house, or maybe I'll expand the deck, or I'll turn the deck into a 3-season room, or that kind of thing. But I don't really have the cash on hand. Well, you've got equity in your property because over the last several years, the market is so tight that the equity has gone up. Or the value of your property has significantly increased in the last bunch of years. So you can go to a bank and say, well, I don't want to touch my first mortgage because the rate is so low, but I'd like to do some work around my house to make it more comfortable for me and that sort of thing. We've got what's called equity loans. So there's 2 different types. You can be a home equity line of credit, which is kind of like a checkbook that has a maximum amount you can borrow. And then you can borrow as much in that line as you want. And then you can pay it back down to zero and use it again for whatever else you want it to. And you usually have that for about a 10-year period where you can increase or reduce the balance anytime you want. And then at the end of the 10 years, it turns into a fixed payment to pay the loan off. And that usually works out well because if you're only paying interest on the amount that you're borrowing. So if you have a $100,000 line of credit, for instance, and you only have a $25,000 balance on it, you're paying the interest on the $25,000, not the $100,000 limit. So that works out pretty nicely, gives you the ability and flexibility to do what you want with it. Then we have what's called a fixed equity, which is kind of like a mortgage, only it comes in behind that first mortgage that you have. And it's a fixed principal and interest payment for a specific term, depending on how much you borrow.
And what do people typically do with that kind of loan? Like, what are projects that they would invest in?
Yeah, people will do all kinds of weird things with it. Go on vacation, pay off their cars, car loans. They'll do, like I said, in terms of making improvements to the property. I think one of the things that's happening these days is you've got families that are kind of caught in the middle. They have children who are either off to college or just coming back from college. Actually, when my kids were young enough, I actually took out a home equity line of credit to pay their schooling bills. And it worked out beautifully because I would pay for the tuition in that first year, and then by the time the second year came off, I would pay it off on the line of credit so that it would work. Or you have, your children are coming back and they haven't found a job yet, so they're moving back into the house. And they're a little older now and they kind of need their space. Or you have your parents who are getting older now and they're living a little further away from you and they really need to have some help in terms of care and that sort of thing. So where the homes are turning into, instead of a single family home, they're adding an additional unit to the house so that they can bring their parents in, or they can have their kids live at the house until they find a job and move on, that kind of thing. So there's a fair amount of that going on.
What do they call it, in-law apartment or something?
Yeah, it's an in-law apartment, and even the cities are starting to look at that because it's the housing issues that are out there are creating some of these unique little spots to work with, and we have the programs to be able to do that.
All right, Gene, regardless of the type of loan that someone's looking for, whether it's a mortgage or a home equity line, what should a consumer look for in a mortgage lender or partner?
You want to talk to, or you want to work with someone who isn't going to be looking at you in terms of what's my next commission going to be. They're going to be looking at you in terms of how can I partner with you to help you get into the best possible situation that will offer you the best opportunity at success. So you're looking for a mortgage officer or a lender who really knows the products that they work with, has a bit of ingenuity in them in terms of having the ability to move in different directions if they need to, depending on what your particular circumstances are. You know, a person who's going to be on your side. The individual needs to have real good experience in terms of that. They also need to be pretty technically savvy, especially nowadays because the technology that's out there to help folks to get into this thing. So that depending on what your most comfortable interaction level is, whether you're more comfortable dealing with technology or you rather speak face-to-face or you want to talk over the phone or you want to chat, your loan officer needs to be able to work in all of those mediums. So I think those are the kinds of things that you want to be thinking about. The other thing you want to think about too is that loan officer going to be with me from start to finish? Or are they going to just take the application, send it off to a processing group, and then from then on, I don't really want to talk to you? In our situation, our mortgage loan officers are with you from start to finish. Yes, it goes into a processing and an underwriting situation, but your loan officer is always available to you when you've got a question or you want to talk about something. They're always going to be available to you, and they're working with your particular circumstances, so they'll really get to know you in terms of you individually and personally. And like I said, they stick with you right from the beginning all the way through to the end, which is a different process in different places.
If I could flip that around for a second, is there a right consumer or borrower that you guys are looking to work with?
A right consumer? Wow, that's a tough one because everybody's so different that I don't really think there is a specific situation that we're looking for. We're so used to... I've been in the business for 40 years now. I think I said that before, and that's a long time. So I tend to say that I've seen everything, and I've worked through everything. Surprisingly enough, I haven't. In the last couple of years, with the way things have happened with stuff that happened in 2020 and in the last several years, I've seen other unique situations, and somehow we've been able to work through those for those individuals. And I think that's probably one of the proudest things that I have as far as my career is concerned, is that I'm pretty flexible in terms of how we work through situations. And even though it's something we may not have seen before, we're more than happy to take a look at it and try to work it through it.
Rooted in the sentiment of hindsight being 2020, let's get into Banking Time Machine. Our next segment, Gene, is Banking Time Machine. What do you know now that you wish you had known then?
Okay, well, of course, I've been in the business for 40 years, but I started with First Seacoast Bank 12 years ago, back in 2013. At the time, I owned a house in the North Country, and I needed to sell that home. And I didn't want to buy a house down here until I sold that home. And so I went into a rental back in 2013. Had I known what the market was going to be in 2022, I would have bought a home way back then instead of the home I bought 3 years ago. It cost me several $100,000 more because of that. So yeah, that would have been a big one.
Thinking about the cliche, what goes up must come down, through the lens of higher rates, a challenging market, all of the variables that are in play for this type of engagement, relationship, investment, etc. What advice would you give someone who's feeling frustrated by the process of obtaining a home?
We are in a fairly difficult market at this point, but I would say this, that everything is cyclical. So that maxim is actually true. Everything that goes up does come down, and everything that goes down goes back up at some point. And you really can't try to, what I call, time the market, because it's just, you're not going to know what's going to happen tomorrow. And there's no, if I knew what was going to happen tomorrow, I would be a very rich person. Nobody has that ability, really. So if you're in the market, you really just need to try to stick to it and continue working until you get to that property. So you think that interest rates today, a 30-year mortgage today is running in the 6.875% rate to like 7.25%. You'd think that's kind of high today, but when I got in the market 40 years ago, the interest rates were in the 13 and 14% range. So 6-7% is not that bad when you're thinking about a net.
Right.
When you're thinking about it in terms of what was going on a couple of years ago, when rates were in the less than 3% range, it seems kind of high. But if you can get comfortable with what you're going to pay now, in terms of that interest rate is not going to last forever. It may go up, but it also has a very good chance of going back down. And it happens with whatever the economy is happening at the time. So if you've got the ability to get comfortable with the payment that you're doing now, working with your loan officer, they can get you a feel for what would be comfortable for you in terms of a mortgage. If you can get comfortable with that now, there's no reason to wait for that, because you never know what's going to happen tomorrow. Sure. If you find that property and you get that property today, go for it.
Gene, appreciate your time.
Thank you. It was a pleasure being here.
Thanks for tuning in to this episode of Bank on It, Conversations with First Seacoast Bank. I'd like to thank my guest, Gene Tremblay, for offering up his thoughts today about understanding the value in your home investment. First Seacoast Bank is member FDIC, equal housing lender. For more information, visit www.firstseacoastbank.com.